Welcome back, everybody. Today we're talking about a company you probably never heard of, but likely are indirectly using every single day. And especially if you go to a website and you see this. And that company is Cloudflare. Now, I told you guys I added it to my portfolio last week, and I actually bought more of it this week already. Today, we're going to do a deep dive on the company, the stock, and I'll explain to you what I saw in my analysis, what I liked and what I didn't like, and what I thought was interesting enough to add it to my portfolio. So let's go ahead and get started. First off, what does Cloudflare actually do? Well, they're a global cloud computing platform, and they use the term connectivity cloud. But what does that actually mean? Well, they tell you right here in the how can you use Cloudflare, they have three components, and one of them is the SASE or SASE, and we'll go over that here in a minute. They have fast app delivery and network infrastructure and full stack development. Now, SASE stands for Secure Access Service Edge, which at a high level is an architecture model that combines network and security as a service into one cloud platform, and the security pieces of that being the SSE. And if you've heard of that terminology before, that's because companies like Palo Alto Networks, Zscaler, CrowdStrike all kind of play in the same area, and they're some of the most popular stocks out there. But in a nutshell, this is how organizations can secure their applications, their data, and still provide access to their employees across the globe. And next is fast app delivery and network infrastructure, and this might be where most people really know Cloudflare, primarily as a content delivery network or CDN, as well as providing services like DNS and protection from denial of service attacks. And this is an area where Cloudflare is one of the market leaders. And lastly is full stack development, where you can leverage Cloudflare's distribution network and speed to build high-performing applications on the edge, meaning distributed all over the world with really low latency. And this idea of edge computing is a really big one, at least to me, because what they're building is the ability to create and deliver serverless applications that integrate with other things like storage that's even compatible with Amazon S3 objects. And the idea here is, imagine you have the big three US cloud providers, which are Amazon AWS, Microsoft Azure, and Google Cloud. And what if there was a fourth one there, which was Cloudflare's serverless cloud? Now, I know there's a long way to go before that becomes reality, but that's one of the big ideas about Cloudflare's future. Now, let's talk about market position, because this gets a little bit tougher to gauge. Because on one hand, you have W3 Techs, who say that Cloudflare is used by over 80% of all websites that use a known reverse proxy, which they estimate to be a little over 19% of all websites. But then you also have 6 Sense, who estimates that Cloudflare's market share for CDNs is around 42%. But then when you look at cloud security on 6 Sense, they claim that they have 98% market share. But part of the issue here is that these are numbers that are talking about different things, so it gets a little confusing. But back in November of 2023, Cloudflare themselves said they estimate about 16% of the global internet traffic goes directly through them, and that would be all actual requests, not just websites. And just to compare, Akamai, which is probably the largest content delivery network out there, handles about 30% of the global traffic. But one of the things that Cloudflare talks about a lot is their reach and speed, with their network being in over 330 cities worldwide, and with 95% of the world's internet-connected population within 50 milliseconds of a Cloudflare data center. So they definitely focus on exceptional speed with wide distribution. So regardless of what you think about the market share metrics or which ones you believe in, there's no doubt that Cloudflare is used a lot, and part of the reason for that is their freemium business model. And you can see it in their pricing plans. They offer enterprise-grade services for free in a way that makes sense for a lot of small businesses and teams. And this is one of those things that differentiates them in terms of customer acquisition. And they talk about it in their investor slides as well, saying they have an inverted go-to-market model since they get their customers first. And we've seen this model a lot with tech companies or social media companies where the goal is to just get a bunch of users first, and then you convert those to paying customers over time. Instead of ramping up your marketing and trying to get people to check out your product, going through long-tail enterprise contracts, you give them something great for free, and as their needs grow, they grow into paying customers. So just to recap some of the notes on their business, they're a global cloud computing platform. And in terms of who their customer is, it's enterprises, but really it's businesses of all sizes. Now, in terms of their total addressable market, it's a combination of all of these things. And honestly, that's part of the exciting aspect of Cloudflare, which we're going to get into a little bit more. In terms of how they're different, it's enterprise grade for all, meaning enterprise grade features, even for free users. They're developer focused and they're cloud edge native. So let's take a look at how they actually make money. So if we take a look at Cloudflare's revenue growth, first off, their revenue is based on subscription plans and usage. And you can see that they've done a little under $1.5 billion in revenue over the past 12 months. Now, their growth rates have been pretty strong, with revenue being over 30% year over year, but we're going to take a look at those trends in a little more detail here in a minute. They only use one operating segment, which I think is like subscription and services or support or whatever they call it, but they do break it down by geography and then also by category, which we can look at. So when you break their revenue down by region, you see that while half of their revenues come from the US, they're definitely an international business, with growth rates being solid pretty much across the board. Now, if we go to the revenue categories, we see that while the vast majority of the revenue comes from direct customers, channel partners is an area that is growing pretty rapidly at over 62% year over year. And those are companies that they partner with to offer Cloudflare services, but through the provider in kind of a broader offering. So let's go ahead and take a look at the revenue in FinChat. Now, I'm going to change this to quarterly. And what we've done here is basically charted their revenue and then with the revenue growth rate as the line here that's cutting across. And so what you see is the revenue has been steady up, right? It's always nice to see a chart that kind of looks like this. It's just going up, right? But when you look at the revenue growth rate, what you notice is that it was above 50% there in 2022, and then it's steadily come down to be in the 30s. In general, you say, hey, if revenue growth is 30% year over year, that's good. But when you see this chart, it might be a little bit concerning because you're like, okay, wait a minute, don't they have decelerating revenue growth? And for being such a kind of earlier stage company, is that a bad thing? First off, I'm never going to say that a 30% revenue growth rate is a bad thing, but I also do think it highlights that part of the story for Cloudflare that's exciting is their growth plan, especially as it relates to expanding their total addressable market. And we can see that here, where in 2018, they basically started in just this application services area that had a total addressable market of about $32 billion. But as they've expanded their offering into these other areas, it's expanded the total addressable market with it. So all the SASE services are right here, as well as the developer services. So it took a 32 billion TAM up to a 176 billion TAM in 2024. And so the interesting part about that is when you talk about a company's growth, there's multiple ways to look at it. First off, what it says is, look, if they're at a little less than 1% of this total addressable market, it means that there's room for growth there for just them as a company to say, look, we're at less than 1%. We can strive to take more than 1%, and that grows the business. But the other advantage is that they're in areas that are also growing. So while they're trying to grow their business, the total addressable market is also growing just because of secular uptrends. And so it means that even if they stayed at 1%, or maybe they got to 2%, then all of a sudden when you get out to 2027, you're talking about, a $4 to $5 billion business. So what's exciting about that is there's opportunity both in expanding their market share in their market, but then also opportunity in the total pie just growing over the next few years. But as we know, that's easier said than done, and this next slide is going to show you why. The competition in all these areas is really fierce. Now, obviously, Akamai is the biggest CDN provider, so they're the big competitor there, and Fastly kind of too, but they're smaller, but they do also focus on edge computing. But then you have the big tech cloud providers, Amazon, Google, Microsoft. And not only do they have a lot of scale, but they have a lot of money and resources to basically do whatever they want. And then if that wasn't enough, you have these security-focused companies like Zscaler, CrowdStrike, Okta that are specialized in that area that are also going to be going after Cloudflare's business as well. So competition is crazy because you have this mix of specialized companies that are able to attack kind of these specific use cases that Cloudflare is going after. But then also you have the big guys who kind of do all these things in bundled offerings, and they have all this money to be able to spend to basically create any product that they want. So just looking at this list, it's obvious that there's no guarantee that Cloudflare is going to win or even survive. Now, I think they're in good position to actually do well long term, but let's go over the risks and opportunities to dig a little deeper. So in terms of top risks, and again, we've touched on these before, intense competition from both big tech and specialized companies. Profitability and business fundamentals are not as strong as some of their competitors, and we're going to dive into that a little bit more later, but just in general, when you have a Amazon or a Google or a Microsoft, these companies that have rock solid balance sheets, they have billions of dollars they can spend on whatever they want, it's going to be hard for anyone to compete, but especially a smaller company that doesn't have quite as good of a balance sheet. And then lastly, the fact that it is such a competitive market means that pricing pressure could become a problem. And we know how this works in other areas, right? You have a Microsoft that has a bundled offering, and their bundle has more value than, say, a one-off provider who still has to make a profit. Whereas Microsoft or whoever can use it as a loss leader, and those type of things are going to be a challenge no matter what, but especially when you have so many people in the same space competing for the same dollars. So in terms of top opportunities, I actually have edge computing platform as number one. And the reason why I say that is because I think they're uniquely positioned to be able to do really well there because they already have the network, they've already focused on speed, and now that they're building that developer platform, it really seems to align really well. But the reason why I have edge computing as the number one opportunity is because of how people talk about it as it relates to AI. Now, we've talked in the past that with AI, you have training and you have inference, and that over time, inference is going to be the bigger need as we start to use these models more out in the world. So if demand for that spikes up, what's definitely going to be needed is very high performing compute power that can go basically anywhere in the world. And that could be one of the big future use cases for an edge computing platform. Now, obviously, I've talked about that they're developer focused. And again, what I like about that is they're creating the tools that developers want to use, which plays into the last top opportunity of customer acquisition driven by freemium models. At the end of the day, they're going to get customers no matter what. Now, it's up to them to convert them into paying customers, but I do think that that model is a differentiator for them in the market. Now, in terms of questions to think about, again, it's all the stuff that we've talked about. Is big tech and their bundled solutions going to really make it hard for Cloudflare to succeed? And then second, is their combo of edge computing, developer platform, and freemium business model enough to be a durable competitive advantage? Like, at the end of the day, we know why Amazon, Microsoft, and Google have a competitive advantage, right? They have these huge ecosystems, huge bundled offerings. And is this enough for Cloudflare to be successful over time? We'll have to see. And then lastly, will they be able to clean up the financial fundamental issues of a, quote, young tech company like high stock-based compensation and minimal free cash flow over time? Now, we haven't talked about this yet, but it's a good segue to go in the operations portion of the evaluation. So if we start with their most recent results, what we see is that from a revenue perspective, last quarter, they were just over $400 million with operating income, this is non-GAAP operating income, by the way, of $57 million. Now, for next quarter, their guidance is 423 to 424 with operating income of, over 50 or so. Now, I tracked them back for the past however many quarters this is, 8-9 quarters, and they basically have done a good job of meeting or exceeding their guidance. And just to be clear on here, just because this says beat, it doesn't necessarily mean that it's good or bad. I guess it's good that they beat, but at the end of the day, what you want to know is, can you trust the guidance that you get in the earnings report, right? And this shows that you definitely can. If anything, it may mean that they're a little bit conservative because they're constantly beating their own guidance. But it also is because the business is growing rapidly. And so at least what this tells me is, when I see this next quarter guidance, I'm expecting them to either meet or beat because they have a long history of doing so. All right, but let's get to capital allocation because here's where it starts to look a little ugly for Cloudflare. Now, first, return on invested capital is obviously not good. It's negative, but their net income is negative because they're not profitable right now. Then shareholder yield also is 0.1. It's not very good. And then their debt, while technically they do have zero net debt, which is a good thing, they do have debt on the balance sheet. The reason why they have zero net debt is mostly because of the amount of cash and short-term investments they have on hand, but they still have over like $1.4 billion of debt in their balance sheet. So, it's good to know that they have zero net debt, but again, this could be better. And now when you look at share buybacks and dividends, obviously they don't pay a dividend. They're not really doing buybacks. They are, but it's not enough to even compensate for the amount of shares they're issuing. And when you see their shares trend, they're up 2.4% year over year. Now, this chart is a pretty ugly chart for Cloudflare. Like normally the type of companies that I go for don't look like this. And I know I had some questions in the comments like, I don't really understand why you bought this when they have these problems. Now, the reason for that is Cloudflare is one of those companies where I'm looking at a smaller or mid-cap kind of company that can add a little bit of growth potential in my portfolio, right? So when you look at my portfolio, it's mostly mega caps. It's Meta, it's Amazon, it's Google, it's Apple. And these are companies with amazing balance sheets, right? Like they're crushing it in this area for the most part. But the challenge with those companies is The growth prospects are the things that everyone's talking about. Just like look at Apple. Everyone's like, oh, they're not growing anymore. It's not worth the premium that you're paying. So Cloudflare is an opportunity where it's a tech company that's in an earlier stage of their life cycle, right? So these type of things are not going to be great. And so if we go to FinChat to look at their stock-based compensation, you can see that the orange is their cash from operations and the green is the stock-based compensation. Anytime your stock-based compensation is higher than your cash from operations, that's not a great thing, right? Like that's a pretty ugly chart. And so when I look at that, if you ask me if that's ideal, the answer is no. Of course, that's not ideal. I don't want that. But I do understand, though, too, that they are a younger-ish tech company. And so sometimes this is the reality, where you have these companies that do this early on as they're growing rapidly, and then over time, they get better. But then if you look at like Snap, they've never fixed it, right? So this chart is like criminal. They have cash from operations is negative. It's finally positive, but look how much stock-based compensation dwarfs their cash from operations. I mean, it's ridiculous. It's like 5 times their cash from operations. So if at the end of the day, Cloudflare becomes like this, then it's extremely bad. But they're not there yet. And even though this doesn't look good, I'm saying, okay, they're a growing company. Over time, this needs to improve. If it doesn't, then I'll reassess. But right now, I understand that it's just part of the nature of the beast in terms of where they're at as a company, and we'll see what happens. All right, so let's look at their profitability. Now, gross profit margin to me looks really good. And when you look at net profit margin and free cash flow margin, I think the real point here that's important is that it's trending in the right direction. So we already know they're not profitable, right? They have net income that's less than 0, but it is trending in the right direction to profitability. And so we can see this in FinChat as well, with free cash flow trending in the right direction, as well as net income. Even though it's negative, it's less negative than it was before. So in general, it's going in the right direction. And that's just something that I just want to continue to see happen. And as they get to profitability, then all of a sudden, these things start to look a lot better. And just for clarity, when I was doing research on different companies, I actually looked at a few that were kind of in the same market cap as Cloudflare or even a little smaller, but had actually some better fundamentals. Like F5 was one that had pretty good cash from operations compared to their stock-based compensation. They had better shareholder yield and all these type of things. And so it looked really strong. But the issue was when I looked at the actual revenue growth of the company, it was a different story. So even though F5's revenues have been growing, the growth rate hasn't been very good. And you can see that over the past decade, it's a compound annual growth rate of only 5%. And if we actually show the growth rate chart, it just, there's nothing over 5% other than a few years over 10. And then this last year was actually negative. So the issue I had with it was if the whole point of adding a stock like this into my portfolio is to get a better growth runway for a company that's in an earlier stage, well, then I want that company to actually be experiencing some growth. I don't want a company with a really great valuation and no growth when the whole point of them being in my portfolio is to have outsized growth. And so when I compared that to Cloudflare, it was really a no-brainer with their 46% compound annual growth rate in terms of revenues. And even though it is decelerating a bit, it's still above 30% with a large addressable market still to come. So in terms of valuation, obviously this isn't going to be good. Their price to cash flow to growth metrics really aren't good. The projected one is okay for next year, but at the end of the day, it's at a price to cash flow of 88. So anytime you're at a price to cash flow of 88, that's just simply not ideal. But believe it or not, it's actually still 90% down from what it was over the 5-year average. But that's because clearly when you look at what happened in 2021 and 2022, the price to cash flow was at some, 8,000 or some ridiculous number. So anything happening now, even though it's 88 and extremely high, is going to look like it's not. But that's not really meaningful information. Let's rate Cloudflare in my 3-tier rating system. So from a business perspective, they have strong growth, an expanding total addressable market, and I think they have a competitive advantage as it relates to edge, as well as pretty good market share in other parts of their business. So from a business perspective, I would rate them as good. Now, as it relates to operations, they do have 0 net debt, and while their gross product margin is good, they still need to see some improvement as it relates to net margin and free cash flow margin, but they are improving in that area. They have stock-based compensation and share dilution that is higher than I would like it to be, so overall, I would rate them as just okay. Now, in terms of valuation, their price to cash flow is over 85. I don't know that I need to say anything else other than that. And they don't even have really a PE because their net income is less than zero. So clearly, from a valuation perspective, I would rate them as poor. But I don't want to gloss over the fact that they're not very attractive from just a core fundamentals and valuation standpoint right now, because they're definitely not. But what they are is an extremely interesting growth story that has the potential to lift the other parts of the business up over time. So to recap the story for Cloudflare, they have a strong product and expanding total addressable market in multiple secular uptrends. Their freemium business model helps for scale and customer acquisition, and their strength in edge computing aligns with AI inference needs. I think their developer focus can actually drive product features faster than other companies, but competition is going to be insanely strong. Now, overall, the growth story is interesting, but the business fundamentals still must improve over time. Now, in terms of what I'm personally going to be monitoring for Cloudflare, obviously, overall revenue growth is going to be critical. Market share trends in terms of CDN and SASE services. And I just want to say SASE services is I can't keep saying that in these videos. I'm also going to be monitoring developer platform growth and then dollar-based net retention rate and paying customer growth. And I just want to talk about these real quick because these are actually KPIs that Cloudflare themselves talks about in their earnings calls. And so the cool part about FinChat is I can actually chart these because they store the KPI data with their other financial data. So here we have the paying customer chart. And the reason why this is important is because, again, they have a freemium model. So they're allowing free users to use their services. And this is a chart that shows how many of the customers are actually paying customers. And so this number has been going up pretty well. And if you look at their growth rates, it was up to 40% a few years ago. And yeah, it's slowing down a little bit, 15%, 17%, now 10%. But the idea here is that it gives us a good glimpse into, are you converting those free users into paying users and at what rate? And if we look at dollar-based net retention, what it's telling you is how much in revenue are you getting from your existing customers? And the reason why this is important is because Cloudflare's whole model is, look, we're going to give you so much value that over time you're going to continue to pay us and pay us more because either you're getting new features that you wanted or adding new things that we're offering to you, or because our features are getting better, or your company is growing bigger to where we're getting more revenue. And so as you can see over the past few years, this dollar net retention rate is well over 100%, which means that they're getting more revenue from their existing customers every year. And then lastly, they have a paying customers greater than 100K ARR. And this is basically telling you how many of your paying customers are giving you more than $100,000 in annual revenue. So as you can see, this has been steadily growing. And even when you look at the growth rate here, yes, it's been going down. But again, this is a company that's growing very rapidly. So it's not like they're going to stay at 78.9% every year. But then when you look at this, you say, okay, my number of customers who are giving me $100,000 in revenue every year grew 10% this year. That's pretty good. So the reason I'm going to be monitoring dollar-based net retention rate and paying customer growth is because it really tells us if that business model is working. So number one, are they bringing in the free users? Number two, are they converting them to be paying users? Number three, are they actually getting the paying users to pay more every year? And then lastly, how many of their paying users are giving them more than 100K in annual revenue? I mean, those are all great to see if each part of that process is working. And to me, that should give some really good insight into how well their business model is actually performing. All right. And then lastly, obviously profitability. They're not profitable yet. They need to be profitable. Free cash flow growth needs to be good. Free cash flow margin, net margin, those need to improve. And then lastly, capital allocation trends, shareholder yield, all those things need to be better. SBC needs to be lower in relation to cash from operations, and shareholder yield needs to be higher. All those things need to happen. But as you guys can see, the reason why these are the top four things is because I really believe that if those things happen and they do well in these top four, then these bottom two will kind of take care of themselves. But that's just my view on it. I know this is a pretty long video, but I could have gone into detail on so many more things. I mean, they have so much going on, and I think that's part of what makes it interesting. But I will say that I did already add more to my position this week. Now, as of Tuesday, Cloudflare is a little over 5% of my portfolio now that I added a little bit more, and it'll probably stay there for a little while. I don't know that I'm going to add a ton more until I start to see those business fundamentals kind of continue to get better. I start to see that growth story really picking up steam. But overall, it's a company I was really excited to add to my portfolio and start monitoring to see where their growth story goes. So what do you all think about Cloudflare? Let me know down in the comments below. Now, if you missed my last portfolio update for August, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins. And I'll see you on the next one. Peace.